For thousands of years, gold was money. Empires rose and fell, but gold remained. It was scarce, durable, global, trusted. And then, in less than a century, it lost its role. Not because gold stopped working, but because something else became more useful for the world that was emerging. This is the story of why gold lost to fiat money, and why that decision still shapes every financial system today. Gold is often described as perfect money, but historically it was not perfect. It solves some problems very well. It is scarce, hard to counterfeit, globally recognized. But it also created limitations. Gold does not move easily across a growing global economy. It does not expand when economies expand. And most importantly, it does not respond to crises. If a banking system collapses, gold does not create liquidity. If unemployment rises sharply, gold does not increase supply. Gold is rigid, and modern economies are not. The 19th and early 20th centuries transformed the world. Industrial production expanded rapidly. Global trade exploded. Credit systems developed. Population and productivity surged. But gold supply grew slowly. That created a structural imbalance. The economy was expanding faster than money supply. This often led to deflation, falling prices. At first glance, falling prices might sound good. But in a credit-based economy, deflation increases debt burdens. Loans become harder to repay. Investments slow down. Unemployment rises. So the world faced a constraint: either slow down economic growth or change the monetary system. The first major break came with World War I. Wars require enormous spending. Under a strict gold system, governments are limited in how much money they can mobilize. So countries suspended gold convertibility. They printed money. They issued debt. They expanded monetary supply far beyond gold backing. After the war, returning to gold proved difficult. Prices had changed, debt levels had changed, and trust had changed. Gold no longer fit the scale of modern government finance. The Great Depression exposed another weakness. During economic downturns, gold systems forced central banks to restrict money supply. But restricting money during a crisis makes the crisis worse. Banks failed, credit collapsed, trade shrank. Governments realized something uncomfortable. A rigid monetary system can amplify economic pain instead of reducing it. Many countries abandoned gold standards in the 1930s, not because gold stopped being valuable, but because it stopped being practical. After World War II, the world needed stability again. The solution was a compromise. The US dollar would be linked to gold, and other currencies would be linked to the dollar. This created a hybrid system. Gold still existed at the center, but dollars became the operational currency of global trade. For a time, it worked, because the United States had strong gold reserves and strong economic output. But over time, pressure returned. By the 1960s, global demand for dollars increased faster than US gold reserves. The system depended on a simple rule: every dollar should theoretically be backed by gold at a fixed price. But governments faced a conflict: maintain gold backing or maintain economic flexibility. They chose flexibility because modern states require financial tools that gold cannot provide: war financing, social spending, economic stabilization, crisis response. The system began to break under its own constraints. In 1971, the United States officially ended gold convertibility. This moment is often called the Nixon shock. It changed everything. For the first time, the global monetary system had no physical anchor. Money was no longer a claim on gold. It became a claim on trust. Trust in governments, trust in central banks, trust in economic stability. This was not temporary. It became the foundation of the modern financial world. Fiat money succeeded for one main reason: it scales. Modern economies require flexible money supply. When recessions hit, central banks can inject liquidity. When economies overheat, they can tighten policy. This flexibility reduces the severity of financial cycles. It also supports credit expansion, global trade, investment growth, rapid innovation cycles. Gold could not provide this flexibility. Fiat money could. And that difference mattered more than any theoretical ideal. Gold did not disappear because trust became irrelevant. It disappeared because trust moved. Today, the real foundation of money is not metal. It is institutions. Central banks controlling interest rates, governments collecting taxes, financial markets pricing debt, global demand for reserve currencies. Money is now managed, not mined, and its value is continuously adjusted through policy. Even though gold lost its monetary role, it did not lose its relevance. Gold still functions as a hedge against currency instability, a store of value during crises, a benchmark of trust in fiat systems. When confidence in money declines, gold often rises. Because gold represents something fiat cannot fully replicate, physical scarcity independent of policy, that is why gold remains in central bank reserves today, not as primary money, but as insurance. Gold did not fail. It was overtaken by a system that better matched the needs of a complex, global, credit-driven economy. Fiat money did not replace gold because it was more real. It replaced gold because it was more usable at scale. The world chose flexibility over constraint, growth over limitation, and trust over physical backing. But the trade-off remains active every day. The more flexible money becomes, the more important trust becomes. Because in the end, money is not just about what it is about what we are willing to believe it can be. If you enjoyed this episode, subscribe for future deep dives into investing, macroeconomics, financial history, and global markets. In the next episode, we will explore what money really is. Subscribe and stay with us. See you in the next video.